Jamie Dimon of JP Morgan, he's been saying, this crisis has been sort of avoided and ignored, the debt crisis, here's government debt. But this time it's probably not going to be washed away, that it's going to have consequences. How about this? If the economy goes into a tailspin because of the busting bubble, like 2000, 2008, initially everybody ignored it for a couple of years. We have a mortgage crisis. It was getting worse. Fed said, no problem. Finally, it busted. That's when the average guy got impacted by a collapsing stock market. He didn't own stocks. He lost his job. His wife lost her job, whatever. All of a sudden, their income dropped. Panic set in, emotion. This time, it's likely to be far worse.
The markets are beginning to unravel beneath the surface, and the smart money is already rotating out of stocks and government bonds. Decades of policy excess have culminated in a distorted financial structure that's now too fragile to withstand any external shock. From Jamie Dimon's warnings to central banks subtly preparing new rounds of stimulus, the signs are clear. The debt crisis that has long been kicked down the road can no longer be ignored. Michael Oliver, a veteran technical analyst, is now sounding the alarm, and his charts say the reckoning will come faster than most expect. In this unfolding environment, confidence in the dollar and U.S. Treasuries is visibly eroding. The U.S. dollar index has already broken below Oliver's bearish trigger at 104 and continues to trade around 98, a level that signals further weakness in fiat relative terms. Meanwhile, the bond market is under enormous stress. Treasury yields are stuck at unsustainably high levels, and any further deterioration could trigger a rapid liquidation, a panic. Once that happens, the Federal Reserve will be forced into emergency action, regardless of how much they wish to preserve their credibility. And when central banks panic, gold doesn't just climb, it surges. What drives precious metals, especially gold, isn't simply inflation or geopolitical drama. As trust collapses and monetary intervention returns in force, gold becomes the recipient of global capital-seeking preservation. That's why Oliver is telling his subscribers to look beyond headlines. Examine the structural failures in the dollar, in the equity markets, in public debt, all of which are screaming one thing: monetary metals are gearing up for vertical price action. In this video, we dive into Michael Oliver's technical outlook, not only on gold, but also on silver, the dollar, T-bonds, and the broader commodity complex. He sees a sequence of dominoes that will fall, triggering an abrupt acceleration in precious metals. And based on historical market behavior, silver may be setting up to outperform. So stay tuned. And if you find value in serious, data-driven commentary on the financial system, make sure to like this video and subscribe to the channel for more weekly insights. We appreciate the support and hope you enjoy the video.
Jamie Dimon of JP Morgan, he's been saying, this crisis has been sort of avoided and ignored, the debt crisis, here's government debt. But this time it's probably not going to be washed away, that it's going to have consequences. In other words, real world consequences, not just chatter about, the debt ratio is wrong. When that happens, the central bank is the chief firefighter. Has to be. It comes in to save the government debt, which saves the government. It has to. So central government policy and central bank policy here and elsewhere, no doubt, will have to shift to more monetary excess once again, even more than they've done regularly. There's always monetary excess, growth in the money supply, artificially low price of money, interest rates. But when this kind of accident lands in their lap, that's when they have to do something fairly dramatic, because it's a huge time bomb. It's not a little one. And that creates further monetary distortion. What drives gold? The ongoing decay in the money units, the real value. And that will be a facilitator to more or less fuel inject the gold uptrend to more vertical manner. So that's why we tell our subscribers, don't just look at gold, look at the stock market, look at the bond market. Look at the dollar, which is now, and by our metrics, we turn bearish at 104. It's trading at 98 right now. US dollar index. That's one piece of fiat versus others. It's not real value. It's just relative. All those things are indicating further fuel for gold because the governments will have to panic. Now, Powell has played this game of poker saying, everything looks pretty good on the economic side. Well, today they just got a number that didn't look so good. And really inside the job market numbers, they don't look good because it's mostly government growth. Last job report was like 50% of the growth was state and local government, essential to the commodity, to the economy, right? Anyway, those data points will go fast to the south, and he'll have to change his mind. And already he has two, and there are probably three or four ready to come on board who want to cut rates now. And he's resisting them as well. Well, suddenly he's going to have to decide, does he want to go down in history as somebody who was fighting the president and even members of the Fed and was lagged to reality? Or is he going to finally get in tune and anticipate, which they're supposed to do, upcoming changes? And I think when they shift, especially when the stock market starts to break and create discomfort, emotion, the bond market remains at high yields, doesn't even have to go higher. But if it did go lower, I think it could be a mini panic. There's certain levels on T-bonds, you mentioned TLT, that if we drop below, and it's several points below TLT, that's all, it could precipitate a puke, a sharp, rapid, instead of an erosional weakness, a sharp panic. Now, undoubtedly the government will take military-type steps to defend against that. So I don't know that the panic would last, but it would cause the government to be provoked, not incrementally, but, all of a sudden in this new direction, central bank. And that is what will inject gold. And I think all these things combined are essentially merely further fuel for the monetary metals waiting when they occur to cause acceleration in what's already going on.
We've lately seen a renewal of concerns about the JGBs and the fact that they might be also a threat to the unwinding of already pre-existing unwinding of the yen carry trade. I've had a great conversation about this with Francis Hunt a couple of weeks ago. What is your take on that? Is this the Achilles heel?
We've not looked at the JGB. I know it's in a similar crisis mode, and I know the Japanese certainly have earned it. Okay, they invented QEs. Okay, and so finally it's coming home to bite. You can try to distort reality and delay it, and they've delayed it. A couple decades now, several decades, but ultimately it creates error, distortions, and now it's come home to their bonds. So we haven't looked at the timing of that situation or the technicals. We're looking at U.S. bonds, but I can see it's going on over there too. You can't have Japan and the U.S. have a government bond crisis. You can't do that. You might as well have World War III. Okay, I'm far more concerned about that than World War III, and I'm sure the central governments are as well. So I don't know what measures they're going to concoct, but we know some of the tools they've used in the past. In fact, the Boston head of the Boston Fed, about 3 months ago, this woman made a speech. It was about a week after Powell gave us another one of his reassuring talks. Everything's great. About a week later, she gave a press conference or a talk, and I forget which, but one of the great lines from her talk was, the Fed is ready to use miscellaneous tools to defend against any financial crisis. Why would she make a statement like that when Powell is reassuring us everything is comfy? And she made a statement, we're ready to use multiple tools. Well, that means not merely interest rates, but QE and who knows what else they've got. Okay, she said that. I can't believe she made a speech or a press conference like that without getting some kind of prior approval. Maybe she didn't, but it was very revealing, that sentence. And I think that's what's behind the doors at the Fed. Even though they smile, they know there's something wrong here, and it's right in their lap. So, print, guys. That's the only thing they've got.
While gold's uptrend is already well established, Michael Oliver points to silver as the more explosive trade in the next leg higher. Technical momentum on silver remains coiled, with historical precedent suggesting it tends to surge violently once triggered. The monetary metal is currently trading at less than 1% the price of gold, a ratio that has only appeared during previous secular lows in silver. Oliver suggests that once the psychological and technical barriers are breached, likely following a Fed policy shift or a Treasury panic, silver's reversion to mean could far outpace gold in percentage terms. Michael Oliver is also closely watching the Bloomberg Commodity Index, which is testing a structural resistance zone around 106.50. This isn't just another ceiling. Oliver argues that if the index closes a month above this point, it will signal the start of a new wave in the commodity bull market that began back in 2020. But this time, he doesn't expect energy to lead the charge. While crude oil is building technical strength, Oliver believes agricultural commodities, base metals, and precious metals will take center stage, with oil acting more as a confirmatory signal than the initiator. Let's get back to the interview.
Because you mentioned commodities, and the Bloomberg Commodity Index is pressing up against its 3-year average. And I want to know from you, how significant is it on a monthly close above 106? And what asset classes do you expect have the most impact if commodities finally actually start rallying?
Last time around, it was energy in that late 2020 to early 2022 move where the Bloomberg doubled in a year and a half. Energy tended to be at the front end of that, oil prices, in terms of percent gain. Grains had a pretty good move, but I'm not so sure it's going to be energy leading this time. I think energy will be dramatic because we have a very clear, not a price level, but a momentum structural breakout that will occur if you close any month during this quarter at $70. Next quarter, it'll adjust down a bit. We're a few dollars below there right now, like pushing at it. You slip out and close over that average, which happens to be the 3-quarter moving average of oil. There's a structure there, meaning when you plot an oscillator momentum chart of crude oil, you would see a trend line that you can't believe the precision of it. When you look at a price chart, you cannot see that structure. In other words, getting over 70 doesn't mean much when you look at a price chart. From momentum, it smacks you in the face. It says, I'm coming out of here. That will probably be very coincident with Bloomberg getting up over 106.50 on a monthly close anytime this year. Annual momentum of Bloomberg is positive, but in the recent pullback, it slipped back below its 3-year average, which in and of itself wasn't structurally important. It's just you cross below the average. Sometimes that's not important. It's the structure on the oscillator. But over the last 2 years, there have been multiple rallies by the Bloomberg, each like 4 or 5 rallies, that each time they get up to 106.50 to 108 in price, there's a ceiling. And they can't close a month over the 3-year moving average. It's a structure. In other words, if you looked at it, you'd see a structure you can't see so well on price. You close over that number, it's saying, I'm up out of the base. I'm breaking out of my base. I'm reasserting the ongoing trend, which commenced in October 2020. This is the next wave. And I think this time the Bloomberg will be in sync but lagged to gold. Like I said, commodities don't always move with gold. There are a couple periods in time they have. Stagflation in the late 70s. Stock market was a wasteland. Commodities exploded. On the tail end of gold, which was already exploding. Then again in 2006, 7, and 8, commodities exploded along with gold. And so forth. So I think they're about to get back in sync so that when you look at the horizon of categories and say, where was the best place to put my money? Well, there's a slightly awakening investor crowd in the US that's finally realizing maybe gold. I think Europeans and Asians have long known this. But the Americans, for some reason, are lagged to that. They're very underinvested in gold and gold related. Gold has been the ongoing place to be, but suddenly you'll look at commodities and say, what's going on here? I thought Trump was going to keep it under control. And it would ambush people intellectually and emotionally if that category started to turn up for no particular reason, other than, of course, it's cheap historically, and the money flow from the central banks goes somewhere. And investors finally say, hey, I think I'm going to put it in commodities. They're cheap. But also look at commodity stocks. That's a great place to be, I think. Agricultural related, energy related, But wait for the Bloomberg breakout, and we time that, and wait for the crude oil breakout. And they're literally just a few percent above where they're trading right now. And I don't think they need a headline to break out. They'll do it on their own with no particular reason. Then you'll start to gush, and then maybe some headlines will occur. But I think that's a place to put money right now. If gold, silver primarily, secondarily, commodity assets.
You wrote also that the commodity spike would also destabilize public sentiment and erode the confidence in both political parties. Well, what do you mean by that?
Well, I mean, the Democrats went through a crisis in the last election, and they're still trying to pick up the pieces, and the party's broken. In fact, there's a far left that's trying to reassert itself like it never has before. The guy running for mayor and so forth wants to, it's fragmented badly, intellectually, organizationally. So that party's sort of crippled now. It's almost as if we're going to head for a multi-party system, like in Europe or Asia, where it's not two parties anymore, it's five. Okay, they make coalitions, which would upset a lot of people in terms of a notion of stability. And again, that's emotional because when you have a lack of stability, a lack of predictability, an inability to understand why is this happening, like oil going up now, or in this case, political. Well, if Trump loses on that primary issue of keeping the average guy's consumer prices low, particularly gasoline prices, that hurts quite a bit because when you pump it, you see the numbers clicking. You know what I mean? It's sort of emotional. If all of a sudden gasoline prices go up by $1.50, the average guy's going to say, well, I thought this party was going to stabilize things. My life is worse than it was before. Who's in charge? So you get, again, this sense of uncertainty that brings emotion. And when you get that element added to the mix, emotion, particularly on both sides now, it's like 52 card pickup. Where are we going? What's going to happen? Okay. And that will, you can imagine the impact that will have on given markets and things that we consider normal expectations. For example, I would throw out these assumptions, and I bet I'll be right. Question is when. I bet there won't be a Federal Reserve in a couple of years. Not so much because the Trump or some of the House Republicans don't want a central bank, but because generally they'll be perceived as a non-functional agency, in the sense that you go back to history of the Fed, and you'll see boom-bust cycles. Monetary boom-busts, followed shortly by stock boom-busts. And even non-ideological economists will look at it and say, it really hasn't been working well. They're always too late or they're too early or whatever. So that could be an entity that's gone, something we think is permanent. How about this? If the economy goes into a tailspin because of the busting bubble, like 2000, 2008, initially everybody ignored it for a couple of years. We have a mortgage crisis. It was getting worse. Fed said, no problem. Finally, it busted. That's when the average guy got impacted by a collapsing stock market. He didn't own stocks. He lost his job. His wife lost her job, whatever. All of a sudden, their income dropped. Panic set in, emotion. This time, it's likely to be far worse. Anyway, I think that's the spiral we're about to face. And I think it could be sudden. And I think uncertainty is one of the key factors. And certainly when commodities turn up for no reason at all, people would assume there's no war. Oil exploded up into the 70s and collapsed right back down in the 60s again. Said, nope, I'm not going to go up because of war. If I go up, it's going to be for an ongoing fundamental reason. One, prices are low. Two, general uncertainty of production, et cetera, et cetera. So that's, I think, the reality we're facing is uncertainty. And when you get that, you get emotion, and therefore you get 52 card pickup. What's the prime beneficiary of that? There's something that you hold that holds its value, and you know it.
Michael Oliver's analysis paints a picture of an economy standing at the edge of a cliff, not because of some distant abstract problem, but because the very tools used to delay crisis for decades have. The Fed, faced with a choice between inflation and collapse, will always choose inflation. They will print, they will distort the money supply, and they will debase the very thing most investors still mistakenly rely on, the US dollar. When this happens, monetary metals won't just rise. They will enter a parabolic phase. Silver remains the most underappreciated beneficiary of this structural unraveling. Its tight supply, increasing industrial demand, and historical price suppression mean that once investor sentiment turns, and it is already turning, the upside could be violent. Add to that the technical signals emerging from the broader commodity space, including oil and agriculture, and we are likely looking at a synchronized breakout in real assets. This will not only shift capital flows, but also undermine political narratives, central bank credibility, and investor confidence in the broader fiat system. Now is not the time for complacency. The volatility we've seen is not noise, it's the early tremors of a larger rupture. Every signal that Oliver tracks, from the breakdown in TLT to the momentum structures in gold, silver, and Bloomberg's commodity index, tells us that the tipping point is near. Investors who understand the mechanics of this shift are positioning now. They're not waiting for headlines. They're not waiting for permission. They're rotating into gold, silver, and tangible commodities because they understand that when the collapse in trust accelerates, price follows. If you found this breakdown valuable, make sure to like the video, subscribe, and share it with other serious investors who need to hear this. We'll continue to bring you the smartest minds in the markets and the insights to stay ahead of the storm. Thanks for watching.